Hello everyone, and thank you for joining today's True Trading webinar. I'm excited to be here with you. My name is Mohammed Azim from Traders United. Risk disclaimer. True webinar house rules. Please take the time to read important rules for webinar attendees. Let me start by sharing a little information about myself. I am a certified Elliott Wave analyst, having earned my level 1 certification back in the year 2012 with a score of 93%. This certification deepened my understanding of market behavior, especially through the lens of Elliott Wave theory. In addition to my work as an analyst, I am also an author and educator. I wrote Introduction to Elliott Wave Theory, a book designed to help traders like you build a strong foundation in understanding the intricate structure of market waves. But my expertise does not stop at Elliott Wave. Over the years, I have expanded my knowledge into broader market analysis, diving deep into market trends, chart patterns, and price action strategies. So whether you are a beginner or an experienced trader, I aim to provide you with valuable insights that will help you navigate and succeed in the Forex markets. With that, let's dive into today's session. These are the session goals. Let me talk about macroeconomic events and data releases. I am going to cover previous week fundamental analysis. The first one is the Swiss National Bank policy rate related to CHF, and we are going to discuss the US dollar Swiss franc. Next one is the GDP, gross domestic product, month over month related to Canada, and I'm going to discuss the USDCAD currency pair. Let us start with the first financial news, SNB policy rate related to Switzerland. Now, what is Swiss National Bank policy rate? The Swiss National Bank SNB policy rate is the main tool used to guide short-term interest rates and shape monetary policy. It influences borrowing costs, liquidity, and the overall Swiss economy. Policy rate changes strongly affect the Swiss franc. Higher rates usually strengthen the Swiss franc by attracting capital inflows, while lower rates weaken it by reducing returns on Swiss franc assets and signaling easier policy. Now, the previous number was 0.00%, forecast was 0.00%, and the actual number we got is also 0.00%. Now, the market reaction we got is the USD Swiss franc actually moved up. Let me show you the chart of US dollar Swiss franc currency pair. So this is the daily time frame of US dollar Swiss franc currency pair. And right over here on 25th September 2025, price action actually moved higher. It moved up after the financial news. So we are dissecting a classic case of it's not just the rate, it's the rhetoric. The Swiss National Bank has just held its policy rate at 0.0% as expected. So the forecast was 0.0%. That was the expectation, but the market reaction has been anything but neutral. The US dollar Swiss franc showed us a bullish rally, which means the Swiss franc is selling off sharply, telling us the Swiss National Bank's message was a powerful dovish surprise. Now let's break it down further. The decision versus the message, if you do the comparison, on the surface, the Swiss National Bank did exactly what the Forex market expected. They expected 0.0% rate, and this is exactly what we have seen. Holding the policy rate at 0.0%, this is what we got. However, the devil is in the details of their policy statement and economic projections. The bank held the line on rates, but the Swiss National Bank clearly signaled a strong easing bias, catching the market off guard and triggering this sell off in the Swiss franc. Now, why the US dollar Swiss franc moved up over here? Well, this is a textbook reaction to a dovish hold. While the rate itself did not change, the Swiss National Bank forward guidance shifted dramatically. They likely downgraded their inflation forecast significantly for 2025 and 2026, expressed heightened concern over slowly global growth and its impact on the Swiss export dependent economy. So this explicitly voiced unease about the strength of the franc and its disinflationary impact by signaling that the next move is most certainly a cut and that it could come sooner rather than later. The S&B made holding Swiss franc less attractive. Investors are selling now in anticipation of lower returns in the future. Now, what actually happened is our pre-release scenario have played out precisely under the Swiss National Bank holds rates outcome, but with the critical dovish caveat. The neutral hold did not happen. The market direction was far from limited or sideways. And that is the reason we got this bullish leg in US dollar Swiss franc currency pair. The dovish hold scenario is what we got. The statement's tone was the primary market driver, overwhelming the neutral rate decision itself and causing a cut-like reaction in the currency. Now, the future policy and the signal that we could get from this number is the Swiss National Bank has effectively pre-announced an easing cycle. The rise in USD Swiss franc shows that traders are now aggressively pricing in a high probability of a rate cut at the next meeting, if not sooner. The central bank has successfully talked down its own currency using forward guidance to achieve easing without yet moving the official rate. So the conclusion and the forward guidance is, so where does this leave us? Well, the Swiss National Bank has drawn a very clear line. Their focus has shifted decisively from inflation risk to growth risks. This meeting has set a profoundly dovish tone for the Swiss franc heading into final quarter of 2025. For Forex traders, the path of least resistance for USD Swiss franc is now higher. So any significant strength in the Swiss franc will likely be seen as selling opportunity, with the market now convinced that the S&B is not just on hold but is actively preparing to ease policy. The central bank has used its words as a powerful policy tool today, fundamentally weakening the CHF near-term outlook. The next one is the gross domestic product GDP related to Canada. Now, what is gross domestic product? The gross domestic product, M over M means month over month, measures the monthly change in the total value of goods and services produced in Canada. A stronger GDP reading generally supports the Canadian dollar because it signals rising business activity, potential for high interest rates, and improved investor confidence. Conversely, weaker results often put pressure on the CAD since they point to slower growth and reduced expectations for monetary tightening by the Bank of Canada. Now, the previous number we got was minus 0.1%, and the forecast was 0.1%. The actual number we got is 0.2%. So we are seeing a fascinating and counterintuitive move in the loonie following a strong GDP report. The Canadian economy grew by 0.2%, doubling the forecast and firmly rebounding from the previous month's contraction. Yet the Canadian dollar is weakening. Let me show you the chart of USD-CAD currency pair. This is the chart of USD-CAD. The Canadian dollar is weakening, pushing the USD-CAD higher, and you can see overall market just keep going up in last few trading days. So we got this news report over here on 25th, 26th over here. And if you check out the previous days, they are bullish. Okay. So we are seeing, I would say, a bullish leg in USD CAD currency pair. This means the Canadian dollar is becoming weak and overall USD CAD is going up. Okay. So let's unpack why the Forex market is reacting this way. Well, let's compare the data with the market interpretation. As far as the financial data is concerned, on the surface, this is an unequivocally strong report. Not only did it beat the 0.1% forecast, but it also convincingly snapped a contractionary streak. However, the price action in USD CAD tell us that the currency traders are looking beyond the headline number and focusing on the broader, more nonsense context. Now, if I explain this thing, well, buy the rumor, sell the news, or US dollar dominance. These are two likely narratives driving the paradoxal move. So if you take scenario one, sell the news, profit taking, it's possible the Forex market had already priced in a robust recovery throughout the week, leading into a stronger CAD heading into the release when the positive data was confirmed. And Forex traders who had bought the loonie in anticipation decided to sell the news and take the profits, causing this bullish leg. So what actually happened in the Forex market is our pre-release scenario need a crucial addendum. The stronger GDP means stronger CAD. And this is what we got. We got the 0.2% number. Okay. Well, the market reaction is something else. Over here, USD CAD just keep going up for the last few trading days, and even on 26 September, we even got this bullish candlestick close in daily time frame of USD CAD currency pair. So what the data alone suggested, a beat should have weakened USD CAD. This fundamental driver was present but was not the dominant force today. So what actually happened? Well, a combination of profit taking and, more importantly, overarching US dollar strength reversed the expected flow, lifting the USD CAD currency pair. As far as the implications for the Bank of Canada is concerned, despite the market's initial reaction, the report is fundamentally positive for the Bank of Canada's outlook. If you take a look at the weekly chart, the overall price action shows downtrend in USD CAD currency pair. So this solid print will give the central bank more room to maintain its current hold stance on interest rates as the urgency for imminent rate cuts has diminished. For the CAD, this provides a solid foundation for medium-term strength, even if it was overlooked. So the conclusion is, in summary, do not mistake the price action for a rejection of Canada's economic health. This was a classic case of a strong domestic indicator overrun by broader market dynamics, especially US dollar strength. For Forex traders, the key takeaway is that the Canadian economy is on the firmer footing than expected, which should limit the downside for the CAD in the medium term. However, in the short term, the loonie remains highly susceptible to external factors, particularly the powerful gravitational pull of the US dollar. The positive GDP data builds a floor under the CAD, but the ceiling for now is being set by the global flows. Next, let us take a look at previous week global market trends, and I'm going to discuss the euro dollar and the US dollar Swiss franc currency pair. So let's take a look at euro dollar currency pair first. Well, as far as the weekly chart is concerned, you see we got this nice bullish price action over here. We can draw a simple trend line, and let me increase the width. Okay, so this trend line shows that we got a nice uptrend over here going on in euro dollar currency pair. Okay, this is the weekly. Let's go to the daily. Now here's the daily time frame, and in daily time frame, same story. This is a nice bullish trend line, and overall price action is staying above this bullish trend line. If we do get a breakdown below this trend line, then obviously the trend is going to change, but overall it's still an uptrend in euro dollar currency pair. Next one is the US dollar Swiss franc. US dollar Swiss franc, um, so far price action just keep going down over here, and this is what it looks like. Nice downtrend going on inside US dollar Swiss franc currency pair. Next one is the daily. Here's a simple trend line over here, and market is kind of testing this particular bearish trend line. So the US dollar Swiss franc currency pair trend looks down. It's a bearish trend, at least based on this daily time frame and weekly time frame analysis. Next, let us talk about current week's macroeconomic events and data releases. I will be covering the key developments in Forex market with a focus on fundamental analysis. Okay, the upcoming news, well, number one is the October 1st, 2 p.m. UTC time, and we're going to get ISM Manufacturing PMI related to USA, and we're going to focus on euro dollar currency pair. Next one is the October 3rd, 12:30 p.m. UTC time, non-farm employment change related to USA, and we're also going to discuss the euro dollar along with some other dollar pairs. So let us start with the first one. What is the ISM Manufacturing PMI in USA? Well, the ISM Manufacturing PMI is a monthly economic index that measures the health of the US manufacturing sector based on a survey of purchasing managers. It is published by the Institute for Supply Management. That's where the name comes, the ISM, Institute for Supply Management, and serves as a key indicator of economic conditions. A PMI reading above 50 indicates manufacturing expansion, while a reading below 50 signifies contraction, with the distance from 50 reflecting the magnitude of change. Now, previous number we got was 48.7%, forecast is 49.0%. The actual data not yet released. So the financial news event name is ISM Manufacturing PMI related to USA, and the date and time is written over here, October 1st, 2 p.m. UTC time. Okay, so the here that we're going to discuss is the euro dollar. So our main focus is on euro dollar. So kicking off the new month and the new quarter, we have a critical high impact indicator from the United States of America, the ISM Manufacturing PMI, coming out this Wednesday at 2 p.m. UTC time. This report is a cornerstone for gauging the health of USA industrial sector. With the index stuck in contraction territory below 50, Forex traders will be watching to see if a rebound is on the horizon. Now, let me show you the big picture first. Well, the big picture is contraction and the Fed implications. The manufacturing sector has been a point of concern with the previous reading at 48.7 firmly in contraction because it's below 50 number. The forecast for a slight improvement to 49.0 still keeps it below the crucial 50 number, boom or bust line, I would say. For the Federal Reserve, a persistent contraction in manufacturing could be a leading indicator of broader economic slowing, potentially bringing forward the timeline for interest rate cuts. A stronger than expected reading, however, would affirm economic resilience. Now, beyond the headline, the key subcomponents are the headline PMI number is a composite, but the market uh, shows often, different reactions sometimes. Market often reacts most sharply to two specific components within the report. Uh, the prices paid index. This is a leading indicator of input inflation. A higher number here could spook the Forex market investors by suggesting pipeline inflation pressures are building even if the overall sector is weak. And second one is the employment sector. This provides an early look at manufacturing job trends, which can be precursor to the broader labor market data. I'm going to talk about the non-farm employment change as well in a minute. The most forward-looking component is the new orders. A strong new orders number, even with a weak headline, could signal a future rebound and be interpreted positively by the Forex market. Now, the potential impact on euro dollar, let's discuss it. Well, if you take a look at the euro dollar currency pair chart, this looks like we've got over here a 4-hour chart, and market is trying to push higher over here, and the trend is still up in daily. Okay, so a surprise return to expansion territory would be a strong positive signal for the US economy. The expectation or the forecast, I would say, is 49.0, but let's say we get a surprise number which goes greater than 50, then that this would likely boost the US dollar by reducing the immediacy of Fed rate cut expectations. In this scenario, we would expect Euro USD to move lower. Uh, if the PMI number comes in line or close to the forecast of 49 number, we get that print could confirm the sector remains in contraction, even if it slightly beats may cause a muted or choppy reaction. The Forex market's focus would immediately turn to the internal components, particularly the prices paid index for future direction. The Euro USD could trade sideways with initial volatility quickly fading. Now, if the PMI number comes weaker than expected, meaning less than 48 number, we get that is a deeper than expected contraction, and it would fuel concerns about the US economic weakness. This would increase bets on a more dovish Federal Reserve, likely triggering a sell-off in the US dollar. In this case, the Euro USD would likely rally. Well, the trend is already up in Euro dollar, and we could then get further upside in Euro dollar currency pair. as the interest rate differential outlook shifts. So the overall analysis is the market is anticipating a stagnant, slightly improving um, number, but still contracting manufacturing sector. The number is still below the 50 level. So the expectation is still below the 50, although we're probably going to get a good number this time because the previous number was 48.7. So if we get a 49 number, that's still a good number, but still it's below 50 level. Now, if the PMI number comes out greater than 50, then that's bullish for the US dollar, and this means the euro dollar currency pair is probably going to start the decline. Okay. So the ISM report sets the tone for a data heavy week, culminating in the non-farm payrolls on Friday. A surprise in either direction could dictate the movement for the US dollar heading into the jobs report. So Forex traders should be prepared for a volatile move at 2 p.m. UTC time, but also be ready to quickly assess the subcomponent data, as the prices paid index can often contradict the initial market reaction to the headline. The key level to watch is the psychological 15 level. Breaking back above it would be a significant bullish signal for the US manufacturing, financial outlook, and the US dollar. The next one is the non-farm employment change in USA. Now, what is the non-farm employment change in USA? Non-farm employment change, also known as NFP, that's a short word. Some people also call it the non-farm payroll data report, is an economic indicator that measures the change in the number of paid workers in the USA, excluding farm workers, government employees, and employees of non-profit organizations. Now, this number uh, is basically released on a monthly basis by the USA Bureau of Labor Statistics, and it is a key indicator of the US labor market's health. So the non-farm unemployment change data report related to USA that will come out on October 3rd at 12:30 p.m. UTC time. The previous number was 22K. The forecast is 52K. The actual data not yet released. So the pair we're going to focus is again the euro dollar, and we could also take a look at pound dollar currency pair as well, because whatever happens in the euro usually also happens in the pound dollar currency pair as well, which is also showing us a nice uptrend over here at this point in time. Okay, this looks like we got a nice bullish trend or uptrend scenario over here in pound dollar. Well, the Forex markets are on high alert for the key economic data release of this week, the US jobs report coming out this Friday, October 3rd at 12:30 p.m. UTC time. After last month's surprisingly soft 22,000 print, all eyes are on whether employment rebounds towards the 52,000 forecast number or not. So this financial data is a critical input for the Federal Reserve and will be a major volatility catalyst for the US dollar and the euro dollar currency pair. The stakes for the Fed and the dollar. Well, this report arrives um, at a critical juncture for the Fed, and a stronger rebound towards that 52K forecast would signal underlying labor market resilience, giving the Fed room to maintain its hawkish stance for longer. This would be a clear positive for the US dollar. However, a strong consecutive weak report would significantly bolster the case for imminent interest rate cuts, likely triggering a sharp sell-off in the US dollar. Beyond the headline is what else to watch as well. The NFP headline is the main event. The devil is often in the details, and forex traders must scrutinize three other key components released simultaneously. The number one is the average hourly earnings. The inflation component, a hotter than expected wage growth figure could reinforce hawkish Fed fears, even if the headline NFP is middling. And the number two is the unemployment rate. A tick higher in the jobless rate in USA could overshadow a decent headline job numbers. And the prior revisions, always watch for the revisions to the previous month's data. A significant downward revision to the already soft 22K could make a meets expectations print feel much better. Much weaker. Potential market impact on Euro USD. Well, if the NFP is slightly higher than expected, meaning you get greater than 75K number or something around 75K, that would be a blowout number, and this is going to show us a bullish signal for the US dollar. It would crush any immediate dovish Fed expectations, sending Treasury yields likely higher and likely pushing the Euro USD sharply lower as the interest rate differential widens in the dollar's favor. Now, if we get the same number, meaning if the number that we get is the 52K number, then it means uh, uh, that's meeting our expectation. Then we might not get any bullish or bearish price action much. We would probably get a sideways reaction in market. So if NFP is now, let's say if the NFP is weaker than expected, meaning let's say we get less than 30K number, that would be a significant miss, particularly if it confirms last month's weakness would be a major red flag. This would likely trigger a sharp sell-off in the US dollar as rate cut probabilities soar. In this scenario, we would expect Euro USD to rally decisively. So overall analysis and the key scenarios is the Forex market is positioned for a recovery. The key question is whether the reality matches the expectations. We see three main scenarios. Well, if we get a number greater than 52K, then US dollar is going to strengthen and the euro dollar is going to drop. And the Goldilocks scenario, uh, if we get a 52K number, well, this is what the market is already expecting. That could be negative for the US dollar, as it suggests a cooling but not collapsing labor market, allowing the Fed to consider cuts sooner. And if we get a number that is less than 30K, then it means it shows a weakness in the United States dollar, and market will aggressively price in a more dovish Fed path. Okay, so the conclusion is ahead of the 12:30 p.m. UTC time financial data release, expect Euro USD to trade in a tight trading range as liquidity thins and forex traders reduce exposure. The immediate reaction upon the financial data news release will be violent, so risk management is paramount. Given the high forecast, the risk appears asymmetric. A miss could spark a more pronounced US dollar sell off than a beat would cause a rally, as the strong dollar native is already partially priced in. So the October NFP will be crucial in setting the tone for Fed policy expectations for the rest of the quarter. Now, let us take a look at global market trends for the current week. And we already discussed about the euro dollar. The trend is bullish in euro USD. Next one is the US dollar Swiss franc. The US dollar Swiss franc currency pair is actually showing a nice downtrend over here. Same goes inside the daily chart. Okay. Next one is the British pound GBPUSD currency pair. GBPUSD is actually testing this bullish trend line over here in daily time frame. So probably on Friday, October um, October 3rd, when the NFP number comes out, we might see a reaction in market in GBPUSD currency especially. So watch out for that number. But the trend is currently up in GBPUSD currency, but this trend could fail as well. Like we might get a break below this bullish trend line. Okay, that's also possible. Next one is the spot gold. Let's take a look at spot gold. So go over to the gold chart over here. Well, the gold trend is actually up. Market just keep going up, up, up. Over here is a nice uptrend going on in spot gold. Okay. This is the weekly. If you check out the daily, same story. There's a nice uptrend in spot gold and daily chart as well. Okay. So the trend looks up in spot gold. We might get a pullback to the downside, and then market is going to resume the uptrend. Okay, if you have any questions or comments, feel free to type inside the chat box and I will be happy to answer your questions. So let us review what we have learned today. Well, we discussed about the ISM Manufacturing PMI related to USA, and then I also discussed the non-farm employment change, the NFP data report, Euro dollar, USD Swiss franc, GBPUSD, and spot gold. These are the assets to watch out for profits. What you should do next? Well, stay tuned for the schedule of next week's trading webinar. Subscribe to our social media pages to stay updated with true exciting events, trading content, and market insights. And if you want to learn more about Forex trading, visit TradeGeek and access free trading courses for beginners, intermediate, and expert traders. Thank you for hanging around. See you at the next trading webinar on Tuesday, October 7th, 2025 at 12 p.m. UTC time. So that's it from my side. Have a nice day and bye-bye.